While many appear to be ignoring the fact, there is a hidden housing crash occurring as we speak. The housing market is clearly in crisis mode, and in 2023, we could be in for a catastrophe even worse than what we experienced in 2008. The Case-Shiller Index, which measures home prices in the U.S., shows that as of the most recent reading for September 22, home prices have fallen from their peak in June by just a small 2.5%. Due to this, many like to claim that homes are merely cooling and that a crash is doubtful. Although we are still 38% higher than pre-pandemic levels, this measurement doesn't really reflect the current situation on the ground. The Case-Shiller Index is well known for being a lagging indicator since it uses an average value that spans almost 3 months. Because of this, even if home prices were to plummet, the change wouldn't appear to be as dramatic on the Case-Shiller Index, especially in the early stages when a downward trend is just beginning. By examining Redfin numbers, we can demonstrate this. As you may already be aware, Redfin primarily serves as a platform for listing homes, and they have access to some of the biggest real estate datasets in the world. Their calculations are not only precise, but also quick. Redfin can analyze real-time listings and calculate averages without having to sift through county records, which are frequently delayed and lag behind the prices we see mentioned on sites like Zillow. The most important question is, what do these numbers indicate? For example, the Case-Shiller Index peaked in June of 2022, while Redfin numbers peaked in May, 1 month earlier than the Shiller. At first glance, this may not seem like a big deal, but if we look closer, we can see a clear divergence that helps to explain why so many investors are in a panic. From top to bottom, prices have dropped by only 2% according to the Shiller, which is a trivial amount. The Redfin report, however, shows that prices have already dropped by 12.6%, which is a significant difference in the real estate market. To see a 13% drop in a short period of time is a huge warning that should tell you everything you need to know about the future of this market. Keep in mind that prices rarely change year over year. The Case-Shiller Index is simply unable to keep up with how rapidly this crash is unfolding. The truth is concealed in plain sight. The crash has already begun. One of the biggest and most reputable accounting firms in the nation, KPMG, just made the announcement that they anticipate the Case-Shiller to decline by 20% by the fourth quarter of 2023. Keeping in mind that this is the national average, the harm will be much worse in markets that are overly inflated. After the pandemic, prices in Boise, Idaho, which had been arguably the most inflated market in the U.S., have already fallen by over 20%, despite a national decline of only 13%. Numerous American cities fall into the same inflated boat as this, which is more than double the average. I bet you're wondering what to do next. Hopefully, you'll click the like and subscribe buttons. Back to the data. Where is all this going if prices are down nationwide by 13%? Many believe that this could turn out to be worse than 2008. Everyone's aware that the housing market crashed in 2008 as a result of bad loans, which were famously dramatized by the infamous film The Big Short. In essence, what happened was that loans became too simple to obtain, which caused homeownership to soar, but not in a good way. A lot of people were buying with incomes that didn't match the debt they were inheriting. And on top of that, new subprime markets enabled people to quickly enter into loans with teaser rates that gave the appearance of affordability. This all burst into flames when the subprime market collapsed and the housing market followed suit shortly after, along with the rest of the economy. But today's loans look completely different. Standards have improved, laws have changed, and the subprime market is essentially non-existent. In that case, what could possibly cause the market to crash if the foundation is strong and sound? Since investors have been leaving over the past 10 years, the answer is fairly obvious, but for some reason, it isn't discussed. Single-family home markets have changed as the result of large Wall Street investors. Numerous businesses have jumped into the market and started buying real estate, including Opendoor, Redfin, Zillow, and many others. These are the so-called iBuyer programs. It was essentially a business where you could receive an instant offer for your home and this big company would then come in and buy it for cash. As a result of these offers, which were frequently above and beyond what was perceived to be fair value in many cases, the market was completely altered. These tech giants were unprofitable and more concerned with growth than making money. This resulted in a situation where prices skyrocketed as a result of home buyers buying hundreds of thousands of properties and relisting them for outrageously high sums of money, inflating entire markets. Therefore, in many instances, these massive institutions were competing for market share and trying to buy up entire cities, even if it meant losing some money on each house. For many years, especially during the post-pandemic boom, this was successful because of the extraordinarily low interest rates and the upbeat atmosphere that helped prices advance at a rate that was unprecedented in American history. Actually, the entire business was a self-sustaining loop because these companies artificially inflated entire neighborhoods, which attracted mom-and-pop investors and smaller businesses that engaged in real estate churning, whereby they would buy a house, change the floor, paint the rooms, wait a few months, and then sell for enormous profits. These actions caused prices to increase even more. What remained was a scenario where investors made up a sizable portion of buyers. Redfin reports in Q4 of 2021, investors bought nearly 1 in 5 homes sold in the U.S. This is even without mentioning that this percentage was even higher in some cities, such as Vegas, where investors purchased nearly 30% of all homes during that quarter. These figures are likely distorted by other data. If we exclude homes that were sold through private transactions and only consider mid-priced homes sold and attracted to neighborhoods, that percentage would undoubtedly increase to absurd levels. The truth is that investors had essentially taken over the market last year at one point, and now everything's exploding. The reason for this collapse won't be bad loans. Rather, it will be the total implosion of iBuyers. Redfin has already effectively liquidated its single-family holdings, and others are battling bankruptcy. It won't be long before investors completely leave the market. Recall that subprime mortgages only ever made up 13% of all mortgage originations in 2008. Even when that 13% was diluted by all other borrowers and homeowners with paid-off mortgages, it was still enough to crash the entire market. Now that between 15 and 20% of all homes are owned by investors, what will happen when they all decide to sell at once? The same forces that drove up prices quickly will actually work against them, as evidenced by businesses like Opendoor, which reported a Q3 loss of $928 million. Many claim that the company is on the verge of bankruptcy, and it's understandable why, so you have to wonder about the future of this industry. In the San Francisco suburbs, you can see that Opendoor can't seem to move any of its inventory. In this case, they listed a house for $2.1 million, and it hasn't sold for nearly 6 months, despite a price reduction of nearly $500,000, and this is just one deal. When you multiply this scenario thousands of times, it's clear why many people are concerned about how long this company will actually last, and how much the industry will suffer if they decide to liquidate. Whatever the case, 2023 will be an interesting year, as real estate buyers and investors might have to flee the market as a result of price collapses. As always, I appreciate your support. If you liked what you saw, please click like and subscribe, and don't forget to leave a comment below if you sold your house to an iBuyer.